Saving for your first home can feel like chasing a target that keeps moving farther away every single month. You set a goal to save 20% for a down payment, faithfully transfer money into a bank account with every paycheck, and watch your balance grow. Yet, when you check home listings a year or two later, purchase prices have surged so significantly that your hard earned savings cover a smaller percentage of the home than when you started. This frustrating reality leaves millions of ambitious prospective buyers feeling trapped on an endless financial treadmill. The traditional instinct is to play it safe, stashing every dollar into a basic checking or savings account where it feels secure from market shifts. However, as housing markets appreciate faster than average wages, that disciplined habit of traditional cash saving often leaves you further from keys to your new home rather than closer. To understand why this happens, we have to look at the core friction between cash holdings and real estate valuation. Real estate prices are dynamically tied to broader market forces, including material costs, land availability, and systemic inflation. When you hold your down payment strictly in uninvested cash, your money remains completely static while the physical asset you intend to buy continues to climb in value. This situation creates a financial dynamic akin to walking up a downward moving escalator. Every dollar you deposit propels you forward, but the underlying inflation rate of real estate continuously pushes your goal back. Unless your cash earns a rate of return that matches or exceeds the rate of local real estate appreciation, the purchasing power of your down payment fund quietly declines relative to the property market. The motivation behind keeping down payment funds in a standard bank account is entirely understandable, rooted in a deep and reasonable desire for absolute capital safety. When you know you want to buy a house in 3 or 4 years, the thought of exposing your hard earned cash to stock market fluctuations can feel unacceptably risky. A standard savings account guarantees that your nominal account balance will not drop tomorrow, offering a psychological sense of control and stability. However, this nominal safety creates a dangerous illusion of security over multi year horizons. While your account dashboard shows that every single dollar you deposited remains intact, its actual purchasing power is quietly being drained. By protecting your principal balance from short term market drops, you inadvertently expose your buying power to guaranteed cumulative erosion driven by ongoing economic inflation. When you combine general consumer inflation with aggressive regional housing growth, the mathematical reality becomes striking. Imagine setting a goal of $50,000 for a down payment today based on average home prices in your target neighborhood. If real estate prices in that area appreciate by just 6% annually, that exact same home will require a down payment of $63,123 4 years later. If your savings are sitting in a traditional account yielding less than 1%, your diligent monthly deposits are continuously fighting a losing structural battle. Even if you manage to save an extra $500 every month, price growth on the property itself can easily swallow those contributions whole. You end up putting thousands of additional dollars into savings simply to maintain the exact same proportional purchase power you had at the start. When you run a direct side-by-side comparison, the true cost of waiting in cash becomes painfully clear. A buyer who places $50,000 into zero growth cash over a 4 year period of market growth actually loses significant wealth in real purchasing terms compared to a buyer who deploys a structured, growth-oriented strategy. Watching years of hard-won effort get neutralized by inflation creates intense financial stress and delays life milestones. Recognizing this reality requires a fundamental mindset shift in how you view financial safety. Remaining entirely in uninvested cash for a multi-year horizon is not a neutral pause or a zero-risk strategy, but rather an active financial decision with a guaranteed cost. By recognizing that sitting in cash carries its own distinct risk, you can begin exploring smarter strategic options to preserve your purchasing power and bring homeownership back within your reach. Your specific timeline for buying a home is the most critical factor in determining how your down payment money should be managed. If your goal is 1 to 3 years away, your investment approach must look fundamentally different from a strategy built for a 3 to 7 year horizon. Structuring a multi-tiered portfolio balances the necessary growth to beat real estate inflation with the absolute mandate for capital preservation. When your purchasing horizon spans several years, holding all of your down payment funds in a single static account limits your future purchasing power. Allocating capital across distinct time-based tiers allows your short-term needs to remain perfectly stable, while your medium-term funds actively work to bridge the gap created by rising home prices. Mapping out this time frame translates directly into how you divide and position your capital across different investment vehicles. Once your target buying date is set, the practical work lies in matching each dollar to an asset class that mirrors your exact level of patience. For home buyers operating on a short 1 to 2 year horizon, principal preservation takes priority over aggressive growth. Short duration treasury bills, certificates of deposit, and high-yield cash instruments provide predictable yields that significantly outperform traditional brick-and-mortar savings accounts without exposing your capital to stock market downturns. By locking in returns through ultra-short government obligations or fixed certificates, you remove market volatility from the equation entirely. These low-risk tools ensure that your core savings remain intact and accessible the moment you are ready to submit an offer on a home. For prospective buyers with a 3 to 5 year window, relying strictly on ultra-safe cash accounts often creates quiet frustration as real estate prices outpace fixed interest rates. Controlled market participation through conservative index funds and short to intermediate bond funds transforms your savings effort into an active hedge against housing cost surges, giving you greater confidence in your financial trajectory. Watching your dedicated home fund steadily build real purchasing power provides strong emotional reassurance that your target home remains achievable. Combining broad equity exposure with fixed income assets smooths out portfolio swings, preserving your peace of mind while keeping your savings momentum alive. Aligning medium-term growth tools with your buying date requires periodic reviews to harvest gains as your horizon shortens. Systematically moving accumulated returns back toward ultra-stable cash equivalents ensures that market gains are fully protected well before you begin touring properties. Navigating account structures and contribution strategies can feel complex, but establishing a clear bucket system brings immediate psychological relief to your financial routine. Splitting your down payment fund into structured, purpose-driven accounts eliminates the chaos of mixing everyday cash with future home equity, removing unnecessary stress from your decision-making process. Utilizing taxable brokerage accounts for medium-term growth alongside a high-yield savings account or money market fund for immediate liquid needs ensures total financial flexibility. Automating your recurring contributions into these distinct buckets frees your daily focus, knowing that your closing costs are fully protected while your broader savings actively compound. To navigate market movements safely as your target buying date approaches, you can implement a down payment glide path. This structural strategy systematically reduces investment risk as you move closer to closing on a house. When your purchase timeline is 4 to 5 years away, a portion of your capital resides in growth-oriented assets like diversified broad market stock ETFs. However, as each year passes, you deliberately reallocate a preset percentage of those holdings into short-duration bonds and capital preservation instruments. By 18 months before your target purchase date, this transition accelerates until your entire capital base sits safely in high-yield cash equivalents or treasury bills. This step-down process locks in accumulated growth while insulating your primary principal from late-stage market corrections. If a market downturn occurs during year 2, your long-term growth assets have time to recover. If a volatility spike occurs 3 months before closing, your capital is already fully sheltered in stable instruments, completely untouched by market noise. Despite the logic of structured planning, taking the leap from cash to invested capital often triggers deep psychological anxiety. The human brain naturally hyper-focuses on the temporary fluctuations of stock portfolios, experiencing loss aversion far more intensely than potential gain. You might feel an intuitive comfort seeing an unchanged bank balance, even though inflation is continuously stripping away its purchasing power. This instinctual fear turns cash into a false sanctuary where safety is felt in the moment, but wealth is steadily lost over time. Overcoming this mental friction requires reframing how you view safety. Uninvested cash offers zero market volatility, but it guarantees a loss of buying capacity in rising property markets. By shifting your perspective to recognize inflation and real estate appreciation as continuous risks, strategic investing shifts from feeling like a gamble to becoming an intentional defense mechanism. Automating your recurring investments further removes emotional hesitation, replacing impulse driven decisions with disciplined execution. To see the concrete impact of this approach, consider two prospective buyers over a 5-year period aiming for an $80,000 down payment. The conservative saver deposits $1,500 every month into a standard bank account, earning nominal interest. After 5 years, their total contributions equal $90,000, barely keeping pace with closing costs while failing to offset rising local home valuations. They have traded 5 years of disciplined work for a goalpost that has moved further down the field. In contrast, the strategic investor channels that same monthly $1,500 into a balanced investment framework utilizing broad index funds and short-term debt instruments, assuming an average annual net return of 6 to 7% across the 5-year window. Compounding interest generates over $15,000 in organic earnings. As a result, the strategic investor achieves their target down payment almost a full year earlier, while contributing significantly less out-of-pocket cash to reach the exact same purchase milestone. While those mathematical projections highlight how capital growth accelerates your timeline, the deeper reality is that waiting in cash costs far more than just lost momentum. When you redefine financial risk, you realize that avoiding short-term market fluctuation often exposes you to a far more dangerous long-term threat. In real estate, standing still while property prices and construction costs rise means your down payment percentage shrinks, forcing higher monthly mortgage costs or locking you out of desirable communities entirely. Controlled market participation is not an act of speculation. It is an active hedge against being permanently outpaced by asset inflation. The structural advantage of this mindset goes beyond buying a single property. When you build the discipline to invest for an intermediate goal like a home purchase, you master the foundational mechanics of long-term wealth creation. You learn to manage risk allocations, neutralize emotional reactions to market cycles, and optimize tax efficiency, turning a short-term home goal into a launching pad for lifelong financial security. Ultimately, transforming your down payment strategy is about establishing agency over your financial trajectory. Watching your money work systematically toward a meaningful milestone transforms homeownership from an exhausting chase into a structured, achievable reality. That sense of mastery builds permanent confidence, replacing financial hesitation with the clarity needed to navigate every major milestone across your life stage journey. Connecting disciplined down payment investing directly to broader life freedom transforms how you experience financial planning. Moving beyond the anxiety of watching real estate prices climb, you evolve from a passive observer into an active architect of your financial future. Taking control of this critical milestone builds permanent financial competence, confidence, and generational stability, proving that structured capital growth can turn seemingly insurmountable goals into predictable, manageable outcomes. While achieving personal agency through active capital growth secures your seat at the closing table. Converting this momentum into lasting success requires a structured, repeatable strategy. Building an effective down payment action plan begins with establishing a concrete target date and calculating your precise capital requirement. Once your timeline is defined, you select an asset allocation that reflects that specific horizon, placing funds needed within 2 years into short-term treasury bills or high-yield accounts, while placing capital intended for a 3 to 5 year timeline into a balanced mix of short-duration bond funds and broad market equity ETFs. To maintain consistency, automate your monthly contributions so capital flows directly from income into designated investment vehicles before lifestyle spending occurs. As you move closer to your purchase date, execute a systematic risk reduction protocol, annually rebalancing your portfolio away from equity funds and shifting those gains into stable, liquid cash equivalents to protect your accumulated home purchase cash. This disciplined evolution from wealth accumulation to capital preservation fundamentally alters how prospective home buyers navigate shifting real estate cycles. Institutional housing reports consistently show that buyers who utilize structured investment vehicles maintain far higher success rates in securing property titles during competitive market expansions compared to those relying solely on fixed bank deposits. For young households and expanding families, this methodical approach eliminates the stress of delayed life choices, allowing couples to purchase homes without draining their primary emergency reserves or sacrificing long-term retirement contributions. By establishing clear risk buffers and automated allocation schedules, prospective buyers protect their family balance sheets from sudden drawdowns while preserving the flexibility to act decisively when suitable properties hit the market. Data from Federal Reserve housing surveys highlights a significant shift in wealth accumulation patterns across modern urban markets, confirming that households who actively grow capital through diversified assets achieve homeownership nearly 4 years earlier than those holding passive liquid reserves. When you finally turn that solid brass key in your front door, it will represent far more than just a physical space of your own. It will stand as tangible proof that by taking control of your financial timeline, understanding the crucial distinction between short-term capital preservation and long-term asset growth, and putting your money to work early in low-cost, short-duration instruments like treasury bills or high-yield accounts, you systematically outpaced housing inflation. Instead of letting rising real estate prices perpetually shift your target, you built a disciplined down payment strategy that protected your buying power, optimized your cash reserves, and secured favorable loan terms. By shifting your perspective from passive saving to strategic allocation, you effectively stopped chasing a moving goalpost and turned years of deliberate financial planning into a place you can finally call home. If you found these insights helpful, subscribe so you don't miss our next breakdown.